Hello, greetings. Welcome to Chapter 3 of Financial Accounting. We're in Week 4, and this is a presentation of this chapter about double entry accounting. The use of accounting terminology to keep the equation in balance, the accounting equation, rather than the information that we have seen in chapters 1 and 2. So that we'll take the information you've learned in chapters 1 and 2, we'll use it as a foundation, and we'll move forward into accounting terminology and understanding of accounting regulations. Now, as I make this presentation today, I will be giving you some back page numbers to make reference for you where you might have seen some of these concepts before, or where we're the part of the previous chapters on which we're building. So let's begin. First, the introductory material. In the very front introduction to the chapter, they show you a new term. It's called fiscal year. And up until now, in chapters 1 and 2, we have been working with a calendar year, a year that started on January and ended in December. Now businesses will be creating fiscal years. Fiscal year is technically defined as any year other than the 12-month calendar cycle. So businesses will choose a fiscal year around the nature of their business. Generally, they will try to identify when their cash flows are the highest and start their year at the cash flows high, and then end their year when business is low. So in a ski resort, for example, they will start their fiscal year September 1st and then close it in August. But any time after spring, they've had a pretty low activity period. So a fiscal year, the other fiscal year that's very common is to end retail years on January 30. They've just come out of the high period of their activity. Now they want to get their inventories very low, and then in February start the cycle over again. So those are just some common examples of a fiscal year, and its technical definition is any year, any 12-month cycle other than a calendar year. Next thing they introduce you to right away is the theory of debits and credits. And debits and credits are accounting terminology. Not very many people use those except for us accountants and business people talking about their transactions. And debit, the word debit and the word credit are new terms that you want to add to your business vocabulary. They're terms that you'll want to begin to understand. If you're not going to be an accounting major, you won't actually use debits and credits. You'll just want to understand the terminology when you or anyone else is talking about debits and credits. The next part of the change in the accounting is the introduction of T accounts. And T accounts come in the paragraph right under debit and credit, and a T account is exactly what it says the name implies, an account that has a crossbar at the top and a leg down the middle, and the name is written at the top, and debits are entries that are made on the left-hand side, and credits are entries that are made on the right-hand side. So as you look at a T account, it's quite simple. It has an account name at the top. It has entries on the left side and on the right side. The entries on the left side are debits, and the entries on the right side are credits. The entries on the left and right themselves do not have any effect or impact any effect on the account balances. The only thing that they do is just record transactions. Recording transactions on the left are debits, and on the right are credits. Now, how those entries affect individual accounts is where the theory of debits and credits come into play. There is an excellent presentation here on page 140 in a green box, but you can look as you read down through there, you'll find that assets are increased with debits Dividends are increased with debits, and expenses are increased with debits. And on the other side of the equation, liabilities, owner's equity, and revenues are all increased with credits. So there are really these 6 categories of accounts, and we have assets, expenses, and dividends, and those are all increased with debits, and liabilities, owner's equity accounts, and revenues are all increased with credits. Remember that we're talking about the entries being on one side or another, left or right. But what that left or right does to the accounting equation is driven by the theory of debits and credits. Now, this presentation on page 140 is key for you to learn. I would encourage you to put a marker there. I'd really encourage you to just make a photocopy of page 140 or draw the table on page 140, depending upon what's most comfortable for you, and then use that as a reference. Over the semester, as you work problems, you will find that there will be, you'll begin to put this to memory even more than you want to, and you'll begin to think about these equations. So as you memorize them over the semester, I'm not suggesting that you memorize anything right at first, only that you work with them judiciously, and you'll find over time you'll be putting them to memory. Now, this is memorizing the theory of debits and credits and how accounts is not a life memory. It's not something that you're going to take with you and use forever, but it is a business education memory. So it's one of those things that you will remember, and then you'll use it again in managerial accounting, and sometimes you'll use it to understand transactions in finance. So as you work in your business education, this theory of debits and credits will come back to you. At that point, the application phase of the chapter begins, and we begin to apply this theory of debits and credits to transactions you've already seen and in categories you've already seen. But now we're going to be increasing them with these accounts with debits and credits rather than with pluses. And we're going to be decreasing them with debits and credits instead of with minuses. So now the minus and plus effect you'll be bringing with you, but we won't be using that terminology anymore. Starting in chapter 3, we'll be using the theory of debits and credit terminology to change account balances. So the first set of transactions we talk about are asset source transactions. You first encountered those on page 14. So you can look back to page 14 and look at asset source transactions. This is obviously when you get a new asset that you can use as a source. So the transactions are presented to you just as they appeared in the earlier chapter. They're presented in now in T accounts rather than in pluses and minuses like you saw before. And the accounting equation is only presented to you in the transaction analysis, whether you're talking about whether something's increasing or decreasing or having no effect. So those are the 3 schematic presentations that are given to you throughout this chapter with these various transactions. If you have any questions about those, mark it in your book, send me an email. What you're wanting to begin to see now is entering these transactions into T accounts. Later in the chapter, we'll add another step, but for right now, it's just entries on the left and entries on the right, and then thinking about whether those entries make an increase or a decrease in the account. Next, we come to asset exchange transactions. It's obviously when you're giving up one asset for another. The list of transactions that are presented there to you are the same events you saw in chapters 1 and 2. but now you're seeing them in a T account presentation, entered on the left or entered on the right, and then looking at an analysis if that entry on the left or the right made the account go up or down. And so you will see those the accounting equation analysis just the way you've seen it in past transactions, but now instead of seeing it relative to pluses and minuses, now it's was it entered on the left or was it entered on the right? And you'll begin to think about how those changes are occurring because of where the entry was made. Next we have and you first saw asset exchange transactions on page 15. Next we see asset use transactions. If you just saw me wave, somebody waved at me, I'm at this window, so I waved back. Asset use transactions, you first saw them on page 16, and they again are presented to you with T accounts. The entries are on the left or the right, and then there's an accounting equation. You can see the change. If it was entered on the left, the debit made it go up in these asset accounts. If it was entered on the right, the credit made the asset come down. Now we have asset claims transactions. You first saw that term on page 19. You first saw it explained on page 149. So on page 149 we begin to, on page 67, I read my notes wrong, I'm sorry. You saw claims transactions on page 67. And so you begin to see the entry again in the T account form, debitor on the left, creditor on the right, and then the theory of debits and credits as making that account go up or down. Now on pages 19 and on pages 80 and on page 84, 19 and 84, the authors restate these transaction types, that basically businesses have these 4 transaction types. They're either acquiring resources and converting them into something and then exchanging them, those new resources outside the business, or they're using an asset within the business to help the business operate, or they're exchanging it for a claim. They're exchanging it for an account payable or some obligation. They could be exchanging it to pay off that obligation as well. Now, on page 149, there's a great deal of important information presented all in one very intense paragraph. So when you get to page 149, look at this paragraph, and I want you to note these, this information. First of all is account balances. And account balances are basically the differences between the way the account went up and the way the account went down. So obviously when it was going up, I hope you'd see that you'd be adding those amounts of money and you'd be subtracting the way it came down. So if you were looking at an asset, for example, it went up with debits on the left and it came down with credits on the right. So when you wanted the account balance, you would have the beginning balance, and then you'd have all the increases that happened with debits. You'd have all the decreases that happened with credits, and at the end you'd get a balance. You hope that you had more increases than decreases, so the balance would be on the left and a positive number, but it could be that the balances were on the right because you had more decreases. That's not a good situation, but we can deal with it. So the normal balance of the account is the way the account is increased. And you want to put that concept to memory. Now, the journal, we're going to introduce you to a new methodology, and the methodology we'll use going forward. So on the general journal, from that point forward, we're going to be writing journal entries to change our account balances. We'll be posting them, we'll be using T accounts, but we'll not be entering entering economic transactions in T accounts. We'll be entering them in journals. Now, economic event transactions, just like you've been seeing, are now going to be entered in journals. You'll have a source document that told you that that transaction occurred, so you'll have a paid check, or you'll have a deposit slip, or you'll have a sales receipt. You'll have some sort of source document that says this transaction occurred. If you don't have a source document, you don't have documentation, then you can't really know that a transaction occurred. You can't write a journal entry without source documentation. And we have general journals, which we're studying now, and then we'll introduce you later to some special journals where you just put the same kind of repeated transactions over and over again in that same special journal. Now, the next part of this is to show you how to write a general journal entry. And I'm going to just look back over here to the page to try to give you a page number. So I have been talking about information on page 151. 152 is massive with journals, writing journals. And so the information about the general journal ends at the bottom of page 149, right after that intense paragraph that I explained earlier. When you look at these pages, starting on page 151 and then this long list of examples on page 152, notice the following characteristics. The date or event number is always flush to the left-hand margin. Then the debit is written first, and it is flush to the left-hand margin in its column. The credit is written second on the line below the debit, and it's slightly indented from the left-hand margin towards the right, indented towards the right. The debit amounts are always written in the first column of account numbers, and the credits are always in the second column of account numbers. If you were keeping an explanation, it would go in the center under the debit and credit. So when you write a journal entry, the debit's on the left and flush to the left-hand margin. The credit is on the second line and slightly indented. The name of the account. And then the amounts are in the far two columns to the right, and the debits are written in the left column and the credits are written in the right column. Now, the rest of the chapter is full of these same events that you've been seeing the whole time, but now presented to you as debits and credits. So on page 151 and 152, they tell you that the chart of accounts is where you'll find the names of all of these accounts to write all these journal entries, and where you would, how you would identify the accounts. On page 152, they show you how you post to ledgers using T accounts. So we won't have ledgers, but the T accounts will substitute as our ledgers for the rest of the semester. And you'll learn how to write entries into T accounts. I've already told you that in T accounts, to get balances, the way the account increases, you add. The way the account decreases, you subtract. And then you put the balance, whichever one of those numbers is larger, and we hope it's the way the account is increased, and that goes at the very bottom. So look for those details. The balances that you get at the bottom of the ledger, the T accounts, is how you make up the trial balance. So now remember, the trial balance is the list of all the accounts you have, and the assets are written first, the liabilities and owners' liabilities are written next, owner's equity are next, revenues are next, expenses are next, and then eventually we will add gains and losses. But for now, you'll just list all the accounts in the order they're presented in the accounting equations. Assets, liabilities, owner's equity, contributed capital first, earned capital second, and then revenues and expenses. then their balances, depending upon if it's a debit or credit balance, are listed in the debit column of the trial balance or the credit column of the trial balance. Now be patient with yourself, be patient with others. People are going to make mistakes because when you first start this, there's so much detail to be aware of and conscious of and to execute correctly, that what you'll find is we'll all make mistakes. I'll make mistakes at the blackboard. Be gracious with me. Be patient. Be compassionate, and let me make mistakes and then show me how I did it wrong. I'll try to do the same thing with you. I'll try to remind you of how these account balances work. Now then, the trial balance then is a proof that the debits equal the credits. That's all it is. It's a proof that the debits equal the credits. So when you get to trial balance, those two numbers need to equal. And they don't say that there are no mistakes. They just say that the debit balances and the credit balances equal one another. You may well have made a mistake by putting something in the wrong account. Trial balance won't catch that. Trial balance will only tell you that the total debits equal the total credits. But we use the trial balance then to create the financial statements. And on page 154 are a set of financial statements. You'll continue to see the same set. It's the same set you've been seeing. They're expanding. We're learning more accounts. We're getting more sophisticated in our transactions. So they're getting to be a little bit bigger. But you want to begin to see that these trial balances feed forward to the financial statement. So the ledgers are on page 153. The trial balance and financial statements are on page 154. Now, after we have the financial statements and they're prepared, then we do the closing process. You learned about closing entries on page 70 and 71. I'm giving you these pages. I encourage you strongly to go back and read those pages right now so that as you begin to use the new information on closing entries, you're fresh on the old information. So read pages 70 and 71 and then look at page 155, because at page 155 we now begin to use the closing entries extensively. We're now going to learn to write the general journal entries for the closing entries, and we'll begin to post those accounts. So, as a refresher, we close the temporary accounts, and the temporary accounts are the revenues, expenses, and dividends. We opened those in order to do detailed information on transactions throughout the year. We want them to go into retained earnings, and at the end of the year we'll put them in retained earnings. So for the first 2 weeks, you used only the retained earnings column, and you put all those revenues and expenses and dividends in there. And so now we're going to break them out into their separate accounts. Those are going to be temporary accounts. They'll eventually get closed into retained earnings. But throughout the process of the year, we'll be putting those transactions into their own accounts. At the end of the year, then, revenues, expenses, and dividends will be closed out to the retained earnings. The individual accounts balances will go to zero, and all those transactions will go into retained earnings. Now, ending the ending cycle. Again, as I said, was on page 170. On pages 70 and 71, and the actual closing process is presented to you there. So, if you have any questions about those journal entries, remember that you're trying to drive those closing entries to zero. Those closing entries, are trying to drive the accounts to zero. So, if the revenues had a credit balance, and you wanted to close them out to retained earnings, you'd have to drive that account to zero by debiting revenues and crediting retained earnings. That credit to retained earnings would make retained earnings go up. And that's just what revenues did in the past, in weeks 1 and 2, in the past 2 weeks while we've been learning this in our class. Same thing with expenses. Expenses are all now going up with debits. You want to drive each one of them to zero, so you have to credit each one of them for its respective balance, and then transfer the total expenses into retained earnings with a debit, and that will make retained earnings go down. So these closing entries, look at the pictures very carefully, look at the transactions, how they're entered, and begin to get a feel for how these temporary accounts are closed and transferred to the permanent account, retained earnings. Now, at the end of this chapter, starting then on page 156 and 7, right in there, we said to you in the beginning that we do these accounting records because decision makers, people who want to loan money to the business, people who want to buy stock in the business, people who want to make transactions, supply relationships with the business, want to know how the business is doing. So they take these publicly issued financial statements, which are in the public domain so people can see them, and they make some assessments about the performance of the business. And we're going to be adding, as of chapter 3, these ratio analysis, this assessment information. So now you'll do all these transactions, you'll make up financial statements. Excuse me. We'll make up financial statements, and then we'll use those financial statements like an outside decision maker would to say, how well is the business doing? So ratio analysis is the common technique that's used for performance assessment at this stage. At the stage in which we're working with financial statements. So on page 157, they say, excuse me again, how well are they using their assets? How well are they using their assets? I want to know how much income did they get with the assets they had to use. And that's called return on assets. There's an equation there, and you can quite simply do that ratio analysis. You'll get a percentage, and then you'll begin to say, is that an earnings ratio that I want under that many assets? And we'll expand the analysis of these for you later. Right now we're just showing the relationships and the math and the nature of the outcome. Is it a big percentage or a little percentage? Is it greater than 1 or less than 1? We want you to begin to see the outcomes that way in these early chapters. On page 158, they ask themselves about debt risk. Have they taken on too much debt? Are they using enough debt? Do they have too high an interest rate? Those are the kinds of debt risk questions that we want to answer. So you will look at debt to assets, and you'll use the debt to asset ratio. And you'll begin to put the total debt in the numerator and the total assets in the denominator, and you'll do that division, and you'll get a percentage. And you'll begin to say, what's the size of this percentage? Is it in a range I would expect to see? Of course, if they have too much debt, you could be in danger, but right now we're not pushing ourselves all the way to that level quite of understanding. We're beginning to just look at that initial percentage and begin to ask ourselves some questions about it and think, why am I looking at risk? Next, on page 158, is return on equity. So of course stockholders are going to want to know, how much return is this business giving us on what we've invested in this business? Now the use, how well are they using the equity that I have invested in this business? Notice when it's return, net income on equity, they're using all the equity, the contributed equity and the earned equity, because it's all the equity. How well are they using it at this point? So that first ratio, so we have these 3 ratio questions that we bring up at the end of chapter 3. We will expand your understanding of ratios. It'll almost feel exponentially at times, but it'll be linear, and we'll just add a few every chapter, and by the end we'll have a long list of ratios. So on page 157, 158, and 158, we set up these ratios for you. We begin to say, go and find these numbers in a set of financial statements, put them into a proportion, a ratio statement, and then do this math. There's a real world data experience about looking at financial statements at the very bottom of that section. Now I ask you to do the appendix because the appendix gives you more economic event transactions, more transactions that you haven't seen before. And so the more I can show you with the book, the fewer you will have to figure out on your own. Now in another couple of chapters, we're going to be asking you to think these through on your own. Right now, we're just introducing you to the concept of journal entries. We're introducing you to the concept of accrual adjusting entries. And so I'm trying to have you use the appendix so that you will see as much material demonstrated in the book as possible. On page 161, they talk about a business that buys a computer. So they buy a computer, and you see that journal entry transaction. And then at the end of the calendar or fiscal year, they want to depreciate the computer. And so they will do this type of depreciation transaction. And remember that computers are a long-term asset. They're going to last a long time. So we don't charge ourselves the full price of a computer at one point in time, but we recognize that we use it over time, so it's an adjusting entry. We allocate the cost of that over the time period we've been using it, and so we record this depreciation expense and this contra asset account accumulated depreciation. So it's a contra asset, runs contrary to the normal asset balances, so it carries a credit balance instead of a debit, and it's used to show the remaining book value of an asset after depreciation. Now on page 162, they have a notes payable and interest expense. They say sometimes businesses have to borrow money. When you borrow money, you have to pay interest expense. So what would it look like if a business borrowed money? So they show you a journal entry where the business borrows money and your cash is going up because more money came in from borrowing, and your obligations or claims known as liabilities, and in this one a note payable is going up because you have agreed to pay back money over a long period of time. These are interest-bearing notes, so you will have to accrue interest at the end of every accounting cycle, at the end of every fiscal year or every calendar year. And then eventually you have to repay both the principal and the interest. Now how those are repaid, at what time and what amounts, is all determined by the information in the note. So when you borrow the money, you're going to have to go back to the note and see, do I have to pay this every year, a principal and interest? Do I send the interest only monthly? Do I send the interest only annually? Do I not pay either one of them till the end? Whatever the note requires are the transactions you have to write. Today in class I was saying, and for those of you in the online class, I said, you can't memorize all these transactions. There are way too many of them. The only thing you can do is think your way through them. Read the economic event. Identify the accounts that are being affected. Then look at use the theory of debits and credits, and decide how that account's going to go up and go down, and how you're going to record this transaction to accomplish the change you're looking for. Well, that brings us to the end of the chapter. So this is a big chapter. Accruals were in chapter 2, accrual accounting, adding these adjusting entries. And now we've introduced T accounts, and then we've shown how information would be entered into T accounts, and then we introduced the theory of debits and credits, debits increase assets, expenses and dividends, and then credits increase liabilities, owner's equity, and revenues. And so as you begin, if you looked at the accounting equation, you could see that if an account that's on one side of the equation increases one way, then it's going to decrease with the opposite way. And the accounts that increase on the other side of the equal sign are going to decrease. So if they're going up with credit, they're going to be coming down with debits. It's a very precise theory. It has served us for a long time. It was developed during the Renaissance as merchants were beginning to trade goods on the Mediterranean, and it was specified by an Italian, and so we have Latin debit and credit. So that's where the terms come from. Well, again, I hope that you'll persevere through. I know these two chapters have a lot of detail, and you have to be an active reader. You have to be reading and picking up your pencil and trying examples and writing things down and just seeing how it feels tactically as well as visually. And I even talk to myself. I mean, you know I talk a lot, but I even talk to myself. This is cash, it's going up, it's an asset, you increase asset with a debit. And so that was, I would walk myself through the journal entries. You can begin to do it softly, or you could be in a place where you can do it out loud, especially write it first. And then later you'll find your mind will just do it for you. If you have any questions on any part of Chapter 3, I welcome an email. I welcome a question in class if you're on the ground class. I welcome either class in my office hours, and I'll be happy to help you. Welcome to the world of debits and credits.